Welcome to the deep dive. Today, we're really getting into something fascinating. We're not just looking at the financial markets. We're digging into how artificial intelligence is, well, fundamentally changing them structurally, often in ways you don't even see.
Yeah, it's subtle but powerful.
Exactly. We're talking strategic shifts, this weird self-reinforcing confidence AI seems to build, and crucially, the biases baked right into the tools millions are using,
Yeah.
for their own money. We'll be leaning a lot on the work of Tenenbaum and his colleagues here, looking at these big financial and tech shifts.
And it's so important we do. It's about understanding what happens when your advisor, the AI, is kind of invested in the advice it's giving you.
That's the core conflict, isn't it?
Yeah.
Advice and market influence have never been this tangled up.
Absolutely. This deep dive is critical because the risks are huge, strategically speaking. We're seeing it from, massive institutional missteps right down to the hidden biases in the AI tools you might use every day.
So our mission today,
Basically, to help you cut through the noise, look past the crazy rising numbers, and really get the structural changes driving this new financial reality.
okay, but before we dive into high finance and algorithms, there's a quick security point we need to hit. Our sources highlighted this, and it's pretty stark.
The deepfakes issue.
Yeah, the rise of AI has led to this explosion in deepfakes.
Mm.
People using your image, your voice data for really sophisticated financial scams.
And it's not theoretical. This is happening now, daily. It's a major threat vector for personal finance, identity theft,
So the very power of AI, its ability to mimic us.
is directly linked to this massive fraud potential. It just underlines how urgently we need, proper judicial control, real regulation over how AI gets used, especially with money, identity, assets.
Because the tech is moving way faster than the rules.
Exactly. And that gap, that's systemic risk, not just for banks, but for you personally.
All right, let's unpack some of this structural instability. There was this huge deal recently, right? A real eye-opener about how institutions might be misreading AI disruption.
You mean the Saudi sovereign fund buying Electronic Arts?
EA. That's the one. The makers of FIFA, Madden, all those huge games.
Yeah, the scale was just staggering. They bought the entire company, $55 billion.
Wow.
And what's really telling is the price. It was a big premium, maybe 25% over EA's market value at the time.
Okay, so when a sovereign fund, which usually spreads its bets, right?
Mhm.
When they buy one whole company like that and pay extra.
It screams that it's not just about the money. There's a deeper strategy. Geopolitical, maybe sociocultural, something more than just return on investment.
So what was the thinking? What was the rationale behind such a massive concentrated bet?
Well, the buyer's logic, it seems, was based on this big assumption about the future of work. A bit flawed, perhaps, but simple.
Which was?
Basically, AI takes jobs, lots of jobs, so people will have way more leisure time. And what booms then?
Entertainment.
Gaming. Exactly.
Hmm.
Gaming becomes the fastest growing sector. And importantly for them, it gives their own population, especially the elite, who, often focus more on leisure, a place to spend time and money.
Huh. So it's like a cultural bet on a future with less work.
Sort of projecting their own social structure onto a global future driven by automation. It's planning for a post-oil world structured around this new reality.
But there are also constraints, right, on where this Saudi fund can actually invest its money.
Oh, absolutely crucial point. They operate under Islamic law, Sharia, and that's very restrictive in global finance.
How so?
Specifically, the ban on riba interest, basically. So most standard finance deals, high leverage stuff, that's out. Plus restrictions on alcohol, pork, gambling.
So their investment menu shrinks considerably.
Drastically, it pushes them towards things like tangible assets, infrastructure, and, culturally acceptable entertainment, like gaming.
It almost makes them a captive investor for certain industries.
In a way, yes. We've seen this pattern before. Think of the Q8 fund, Kuwait's fund. They made huge investments in European hotels, football clubs.
Right, those weren't always the top financial performers short term.
No, but they projected influence, soft power. The EA deal feels similar. Buying a seat at the table in the future global conversation about leisure and culture.
Okay, so there's a cultural logic, legal constraints pushing them. But you still see this $55 billion deal as a strategic mistake, economically speaking. Why?
Because it bets the farm on the gaming industry as it exists today being stable, and, it just isn't.
How so?
First off, EA doesn't have a monopoly. It's a super competitive space, constantly churning out content. Second, and this is the big one related to AI,
Yeah.
the real giants, the core AI companies, Microsoft, Google, They aren't just competing with EA, they're changing how gaming is even delivered.
You mean like cloud gaming, streaming?
Yeah, integrating gaming as a service. Just another feature in their massive ecosystems. Microsoft owns Xbox, they have Azure AI, Google has its cloud, they can bundle gaming in.
Okay, so if gaming just becomes a feature, not a standalone product you buy,
Yeah.
what happens to EA's $55 billion valuation?
Well, this is where the core insight from the analysis comes in, the point Tenenbaum also implicitly touches on. Any industry that isn't core AI is fundamentally unstable right now.
Any industry, that's a big statement.
Think about it. AI companies are starting to just absorb adjacent services. Take SAP, the huge German software company. Enterprise planning, logistics, HR companies paid millions for that.
Right, very specialized, complex software.
But now, large language models, custom AI tools, they can start doing those basic management things. Inventory tracking, scheduling, compliance checks, just as simple services built into the cloud platform you're already using.
So they turn SAP's product into just a feature.
Pretty much. If your Google AI subscription includes a great inventory tracker, why pay SAP extra? The function gets unbundled, absorbed. If that can happen to complex enterprise software, imagine gaming. It relies totally on engagement.
So investing $55 billion in a non-monopoly gaming company seems risky.
It's a profound risk. If, say, in 5 years, Microsoft just gives away gaming as a free perk for its AI subscribers. The concentration risk is huge. They put a massive chunk in one company, in one industry, that's sitting right on an AI disruption fault line.
So if the goal is diversifying away from oil, this doesn't look like the safest path.
Not from a risk perspective, no. Compare it to, say, Norway's fund. They take tiny stakes in thousands of companies, spread the risk, benefit from overall growth, buying one whole company at a premium, especially one facing this kind of threat. That looks more like buying influence than buying resilient economic security for the future. They might have overpaid for that influence.
Okay, that EA deal really highlights the risk when big institutions misunderstand AI. But let's shift now to the individual investor, because the same AI tech is creating biases that affect everyday decisions. And the numbers are kind of staggering.
The stat about people consulting AI before trading?
Yeah, something like 2/3. 66% of people now ask an AI, usually ChatGPT, before they buy or sell a stock.
That number alone signals a massive shift. In market psychology and where people get their information, it means most people are now plugged into the same algorithmic consensus at some point.
But surely the AI is just objective,
Right.
synthesizing data, giving the best statistical answer.
That's the ideal, maybe. But we need to understand the AI's motivation. As Tenenbaum and his colleagues discuss, it's not built purely for objective truth. It has a commercial goal.
Which is?
User retention, engagement. Think of it less like a neutral calculator and more like, well, the source used the term chupamedias, a flatterer, someone who keeps things positive.
A flatterer. Why would an AI need to flatter?
Because it's selling a service. Whether it's a subscription or just keeping you clicking, it needs you to have a good experience. And let's be honest, positive market news generally feels better, keeps you engaged more than pessimism.
So if it says market's crashing, sell everything,
Yeah.
you might just log off.
Exactly. You feel anxious, you stop using it. But if it stays optimistic, suggests promising stocks. You stay engaged, you trade more, you come back. Positive reinforcement drives the platform's success. It's psychological engineering, almost.
Right, so the optimism is a feature designed to keep you hooked.
Precisely. And this leads directly to that inflation of confidence Tenenbaum's research talks about. It creates this potentially dangerous, self-fulfilling prophecy.
Okay, walk me through how that works, the loop.
Right. So you ask ChatGPT, say, should I buy NVIDIA? The AI gives a positive response. Partly based on real strength, sure, but also reflecting the consensus from millions of other people asking similar questions.
Okay, so I buy NVIDIA.
And because maybe 2/3 of the market is doing something similar, getting similar positive nudges, there's this huge wave of buying pressure specifically on stocks like NVIDIA.
Which pushes the price up,
Yeah,
naturally.
correct. Then maybe a few weeks later, you check back with the AI. How's my NVIDIA doing? The AI sees the price went up. So its original advice looks brilliant. It gets reconfirmed by the very market action it helped create.
And my trust in the AI just goes up, locked in.
It's a feedback loop. Algorithmic consensus shapes the market reality, and that reality then validates the algorithm. Deeper trust, more concentrated buying.
But hang on, let me push back a bit. What if those top AI stocks, the NVIDIAs, the Microsofts, the Oracles, What if they are genuinely the best, most powerful companies right now? Isn't the AI just efficiently pointing people to real value? How do we know it's bias versus just good advice?
That's the million-dollar question, isn't it? And the difference, I think, lies in the speed and concentration of the growth and how detached prices seem to be getting from traditional fundamentals.
Like those huge single-day jumps.
Exactly. A stock like Oracle jumping 30%, 40% in a day. Valuations reaching really stretched levels, historically speaking. Yes, these are strong companies, but that kind of movement suggests demand is being driven by something more than just, steady earnings growth. It feels like capital has to flow into these names because the consensus algorithm demands it.
The AI is essentially creating demand for its own ecosystem.
It's prioritizing assets within its own sphere of influence, yes. Generating demand that maybe outpaces the organic business growth. That helps explain this, like incessant rise in AI stocks, even when results aren't always perfect.
It reminds me of this story. One of my first, most painful lessons trading. Early days. Had this broker. Seemed super legit, old school type. Pulls me aside in the men's room, gives me this hot tip. Buy Masu, he says. Paper company.
Uh-oh. The men's room tip. Never a good sign.
Tell me about it. So I get all excited, call my client, buy 100 shares. Then I go down to the trading floor, and everyone's trying to buy Masu. Huge crowd. But only one person is selling.
Let me guess.
It was him. The broker. He just needed someone to sell to. Needed the liquidity. I was the exit.
Ouch. Brutal. But a classic lesson.
Yeah, the lesson stuck. Be very, very careful buying when everyone agrees. You might just be providing the exit liquidity for someone who got in earlier. And this AI dynamic, it feels like a high-tech, scaled-up version of that same consensus trap.
That's a perfect analogy for the herd risk. And this bias is not just pumping up the winners, it's actively hurting everything else.
So,
The overall market might hit new highs, yeah, but it's being pulled up by just a handful of these AI-related stocks, maybe 10, 15 names. Meanwhile, money is actively being pulled out of other sectors, non-AI tech, consumer goods, industrials. People are selling those to fund their AI buys.
so the AI's optimism creates this split market, a tiny group of winners soaring, paid for by selling off the rest of the economy.
That's what it looks like, a highly bifurcated, concentrated market,
Yeah.
driven by that AI consensus engine.
Okay, so we have this crazy concentration, this rapid growth, fueled by AI consensus. The big question everyone asks is this just another bubble? Like .com in 2000 or the financial crisis in 2008. Is it going to pop?
It's the natural comparison to make, absolutely. But the analysis we're drawing on suggests this situation is, well, maybe exceptional is the word. It might not play out like past cycles, at least not in the same way.
Why not? Both 2000 and 2008 involved huge mispricing, right?
True, but a key difference seems to be leverage, debt. In 2008, the whole system was drowning in debt, housing debt, complex derivatives, shadow banking. In 2013, lots of margin debt. Right now, the market doesn't seem that heavily leveraged in the same way.
Meaning people aren't borrowing huge amounts to buy NVIDIA stock.
Not on the same scale, generally speaking, so if prices drop sharply, yes, it'll hurt, there'll be a correction, but maybe not that systemic domino effect collapse driven by mass margin calls, wiping everyone out instantly.
So the risk isn't maybe a sudden debt implosion, but more like a failure to meet expectations, a slower deflation.
That could be part of it. And the second difference is the underlying thing itself. Unlike many dot-coms that were just ideas on paper, AI is real. It's transformative technology. We don't really expect AI itself to just fail.
Right. The tech works.
Yeah, the risk is more about delays, setbacks, or just the valuations getting way ahead of the actual practical rollout and profit generation. Meeting those incredibly high algorithm-fueled expectations is the challenge.
But the truly unique thing, the structural difference that really sets this moment apart, it goes back to the advisor itself, doesn't it?
That's the absolute core of it. The financial advisor, the AI, is the technology it's recommending.
How does that change things fundamentally?
Well, the AI has access to effectively infinite data, and it has this built-in structural optimism about its own ecosystem, its own technology. It's inherently incentivized to recommend things within its own world.
So when you ask ChatGPT about investing,
You're essentially asking a system built by and running on the infrastructure of the tech giants whether you should invest in those tech giants. It's like asking an oil company if fossil fuels have a future.
the answer is somewhat predetermined.
There's a powerful bias baked in. It's an internal feedback loop where the system promotes itself.
And this gets amplified by what the source calls endogamic deals. Tell me about this.
Endogamic meaning like internal within the group. It refers to this web of continuous, mutually beneficial deals and cross-investments among that core group of top AI players, the top 10, 15 companies.
Can you give an example?
Sure. Think about NVIDIA. They sell their GPUs, their chips, to ARM, but NVIDIA also holds a financial stake in OpenAI. OpenAI, meanwhile, uses huge server farms, maybe from a company like CoreWave, and guess who might be a major owner or investor in CoreWave?
NVIDIA again?
Could be, or another player in that core group. It's this complex network of buying, selling, investing, all within the same small circle.
So it's like a closed economic loop. The money just circulates inside.
Pretty much. The system constantly reinforces itself. When NVIDIA reports great sales, some of those sales might be to companies it partly owns, or companies using its tech to service other companies it owns stakes in. It's a perpetual motion machine, financially speaking.
And that just keeps amplifying the positive signals for those specific stocks.
Exactly. It creates a powerful echo chamber effect in the market.
But wait, what's the actual risk there for an investor? Doesn't that just show these companies are collaborating efficiently?
Yeah.
That they're tightly integrated?
It does show integration, yes. But the risk is fragility. It's a lack of diversification even within that core group. If one key player in that loop, say, a crucial server provider, like that hypothetical CoreWave, hits a major snag, a tech failure, a security breach.
The shockwave doesn't get spread out.
No, it gets amplified throughout that closed loop because they're all so financially and operationally tangled up. It creates a hidden systemic risk that standard market models might miss. It's concentrated interdependence.
Wow. Okay, and this closed loop,
Hmm?
it's about to get even tighter, isn't it? With this shift from AI giving advice to AI actually doing the buying and selling.
Yes, agent revolution. This is the next big operational leap, and it could really redefine commerce.
Like OpenAI's announcement.
Exactly. Integrating directly with platforms like Shopify, Etsy, allowing you to just tell the AI through the chat, buy me this thing.
So instead of asking, should I buy new running shoes?
You just say, AI, find and buy me the best rated running shoes for my needs under $150. The AI becomes your personal shopper, your agent, executing the deal.
And that directly threatens the big online marketplaces, the Amazons, the eBays. Why?
Because it slips a new layer between the customer and the platform. If the AI agent is choosing the product, finding the best price, clicking buy, the platform loses control over that customer journey. Their search rankings, their recommendations, they get bypassed.
The AI controls the transaction point.
Right. The power shifts from who owns the website or the inventory to who owns the agent that the customer trusts. It's a whole new battleground for controlling digital commerce.
So this AI optimism bias, it's clearly driving tech stocks. Does it spill over? Does it affect other big investment areas?
Oh, absolutely. The bias isn't just about tech. It's sort of dispositional. It favors action, confidence. The AI is trained on huge data sets covering the whole economy, human behavior.
So if it sees certain trends.
Right. If the AI analysis looking at macro trends, inflation, whatever, develops a tendency to believe in brick and mortar, let's say.
Meaning real estate.
Yeah. Maybe it sees it as an inflation hedge or perceives stability there. Then the AI recommendations start subtly favoring real estate investments, REITs, property funds. Money flows there because the AI narrative deems it safe for growing. The bias just encourages capital movement, often toward whatever the current AI consensus favors.
Okay, shifting gears a bit. Tenenbaum and the research team brought up something really speculative and kind of mind-bending about AI hardware meeting crypto.
Ah, yes, the tokenization question. It's provocative, isn't it? How long before a company like NVIDIA, with just total dominance in essential AI hardware, how long until they decide to tokenize their GPUs?
Tokenized, like create a cryptocurrency backed by their graphics cards.
Exactly. Imagine an NVIDIA token where each token represents a fraction of ownership or maybe access rights to their physical computing power. That token could instantly have more credibility, more trust than probably 99% of the cryptocurrencies out there right now.
Because it's backed by something real, something essential.
Precisely. It's got a tangible anchor, the hardware running the world's AI. It has undeniable utility.
Yeah.
Compared to purely speculative digital coins, a GPU-backed token from NVIDIA. That could be a game changer, a whole new kind of asset-backed digital currency, potentially bypassing a lot of traditional finance. Really disruptive potential there.
Wow. Okay, completely different track now. You were at a big financial conference recently, and you said the conversation had shifted dramatically, not just speeding up settlements from T+2 to T+1.
No, that felt like old news almost. The real buzz, the central topic everyone was grappling with, was the inevitable move to 247 markets.
Trading around the clock.
Yeah.
Stocks, bonds, everything.
That's the direction. Instantaneous, continuous operations. Crypto already works like this, of course, but bringing that model to mainstream finance is a monumental shift.
Can you just quickly remind us why we have T+2 or T+1 now? Why the delay?
It's basically a hangover from the days of paper and human processing. T+2, trade date plus 2 days, gave banks time to verify trades, swap paper certificates back in the day, handle currency conversions across time zones, sort out any errors. It built in friction for human workflows.
But now with everything digital and algorithmic.
That lag is just inefficient. It ties up capital. Institutions want their money settled instantly, freed up for the next trade. The pressure for real-time settlement is immense.
Yeah, humans can't work 24/7. How does Wall Street function at 3 a.m. on a Sunday?
Well, effectively, it doesn't right now. And that's precisely why AI becomes non-negotiable in a 247 world. I talked to this former Forex trader once. He described having to set alarms literally every hour through the night for 18 hours straight sometimes just to check currency pairs. Burn him out completely in a couple of years.
Just unsustainable for people.
Totally. Humans are too slow, need sleep, get tired, make mistakes. We're geographically limited by time zones. We simply cannot manage truly global, instantaneous, always-on markets.
So AI steps in.
It has to. AI will handle the overwhelming majority of 247 operations, executing trades, managing risk second by second, providing liquidity when human traders are asleep.
So it's another structural change where the market itself is evolving to basically require AI, making human traders less relevant, or at least slower.
Exactly. The environment is actively optimizing itself for the capabilities of the algorithm, not the human. The human edge diminishes further. #outro.
This has been, well, a genuinely deep dive. How AI isn't just analyzing markets, it's actively building them. So for you listening, trying to navigate this really concentrated, fast-moving landscape, what's the main takeaway?
I think the key conclusion, and it echoes the final point Tenenbaum emphasizes in his analysis, is this. When you get investment advice from AI, you have to be acutely aware of that built-in bias, the bias towards optimism, towards self-promotion.
Remember, it's designed for engagement, not necessarily pure objective truth.
Right. But here's the paradox. If 2/3 of the market is getting that same positive advice and acting on it, well, following that consensus might actually work. For a while anyway. Because the consensus itself is driving the prices.
So the million-dollar question becomes, how do you tell the difference between a genuinely good investment and just? The loudest voice in the algorithmic echo chamber.
Critical thinking is still paramount. You have to constantly ask, is this advice backed by real-world fundamentals? Or is it just validated because every other AI is saying the same thing? Those old cautionary tales about herd mentality.
Like my Masu story.
Exactly like your Masu story. They're still relevant. But the mechanism is different now. It's not just a shady broker unloading stock. It's maybe an algorithm selling you on its own importance, its own ecosystem.
Okay, so what's the final thought we leave people with? The provocation.
It builds on everything we've discussed. If this current environment is truly unique, with these internal self-feeding deals, maybe less traditional leverage, this inherent AI optimism. And if you literally have AI instances buying stocks because other AI instances recommended them, then the big question is, do the old rules even apply?
Do historical patterns, cautionary tales from past market crashes, do they still hold true?
That's what you have to decide. Are we in a fundamentally new kind of market, one that's structurally optimized for the algorithm, not for human psychology or past economic cycles? Or are the old lessons just waiting to reassert themselves in a new guise? That's the question to grapple with.